We're good. We're recording?
They record.
Okay.
Yeah.
All right. Good morning, ladies and gentlemen, and welcome to the Police Pension Fund Investment Meeting for December. Make our introductions for the record.
Stephanie Zimberg, representing Commissioner Sewell.
Allison Hirsch, representing Controller Bradley.
Steve Meyer, I'm an invited participant.
John Dosa, alternate for Control Bradley.
Kevin Leo, representing Finance Commissioner Network.
Shimon Ray, representing Mayor Eric Adams.
Joel Alejandro, PBA.
Chris McGrath, PBA by invitation.
I just want to, Artie Egner's on Zoom, I believe, so.
Okay.
So be quiet.
We'll get, we'll get.
Rob Appling, Wilshire by invitation of the trustees.
Nicole Jambrisi, Police Pension Fund, present by invitation of the pension fund.
Jeffrey Ward, DEA.
Dan Maragli, representing Chris Monahan, CEA.
Vic Swinton, representing Lou Turco, LBA.
Anthony Borelli, SBA.
Andy Ventura Miller, Police Pension Fund, present by invitation of the pension fund.
Bob Sanskisted, Pension Fund, present by invitation, also present.
Robert Frank, Controller's Office, by invitation.
John Mercerburn, Controller's Office, present by invitation. Pat Gunner, Controller's Office, here by invitation.
Dinesh Kajela, Controller's Office, here by invitation.
Dylan Herman, Axia by invitation.
And also present, we have, Law Department,
I don't believe they're participating today.
Actuary.
Tom O'Hara, here from the Actuary's Office.
And, who else we got? Artie Egner.
Artie, are you online? May have had trouble by now.
Yes, not. All right, and we have, various support staff from the, Controller's Office also.
Yeah,
Right.
and we'll ask those folks that, to identify themselves if they, participate in the meeting.
And with that, John, I'll, turn it on over to you.
Great. So good morning, everybody. Before we get started with the executive session, I'll turn it over to Steve Meyer, the CIO, to give us a quick presentation
Were you able to now or no?
in public session.
Great, thanks, John. And good morning, everyone. I'm just going to provide a brief update on the economy, the financial markets, investment markets, and your portfolio's performance for Q3. Let's dive into it on the first slide, Kate. So inflation hit a 40-year high in the third quarter. The good news is, however, the fourth quarter reports have been somewhat encouraging, and inflation pressures are coming down. Employment rates continues to be significant on inflation, with wage price inflation.
You want a microphone?
On services.
Hold on one second. I'm hearing like feedback or someone talking.
Yeah, he's on.
Sorry, Joe is trying to coordinate with Artie from the PBA.
You don't see his iPhone?
Well, if he's on from his phone, his name's not here, so if he's iPhone, can he unmute and say something?
Yeah, can you unmute, Artie? And say something?
Okay.
All right, Artie, just identify yourself.
Artie Egner with the PBA.
You got that, Yaffa?
Yeah, I got that.
I recognize that.
All right, thanks, yeah.
Glad it's you today, Yaffa.
All right, very good.
Great.
All right, sorry about that, Steve.
No, not at all. So we'll continue on inflation. Obviously, we've got wage price pressures here in our market, primarily in services. We also have some residual supply chain bottlenecks, continue to put pricing pressures on final goods. Also, with the energy shock associated with the Russian invasion of Ukraine, we still have an energy price shock as well as reverberating through the economy. Fed Chair Powell last week reflected an inflation that spread broadly throughout our economy. On the next slide, just a look at CPI and the PCE deflator. CPI is off its 40-year high. It hit a 40-year high of over 9% in the third quarter, but it's comfortably moved below 8%. And we get another CPI report next Tuesday before the Fed decision on Wednesday. Core PCE has been sticky at elevated levels at just 5%, down from November revised lower, upward rather, October numbers of 5.2%. But even PCE is expected to move lower in coming months. Next slide. Global inflation's been an issue or challenge around the world. Here you can see on the right-hand side, the red line is the CPI in the U.S. As I said, it's peaked and is moving lower. However, it hasn't done so in the U.K. That's the upper gray bar at over 11%, and the Eurozone continues to have inflation at just about 10%. But off the boil, it's off from a high of 10.6%, perhaps moving in the right direction. On the next slide, the University of Michigan survey results show lower inflation expectations as well, comfortably moving below 5%, but there's more downward move to be had. I think they're at 4.9%. On the next slide, employment continues to be very strong. Last week's November employment report was quite solid. We've had upward revisions for the prior 2 months and numbers that for October and November that have exceeded expectations. Third quarter unemployment hit a 50-year low of just 3.5%. In November and October, unemployment was 3.7%. So, again, stronger than expected, but still incredibly low and a continuing challenge for the Fed. On the next slide, we still are suffering from a post-COVID persistent imbalance in our labor market. There's about 4 million open positions above what the labor force supply is these days. So again, more demand for workers than there is supply. The Fed hopes to balance the labor market by slowing job growth, which is behind its increases in rates and its quantitative tightening. And the labor force participation rate, which is in the yellow on the screen, is still about 1 percentage point below pre-pandemic levels. The next slide, U.S. third quarter GDP growth is plus 2.9%, which was revised higher last week from 2.6%. This follows 2 consecutive quarters of negative GDP growth in the first and second quarter of the year. And the fourth quarter actually looks moderately strong, notwithstanding the fact that the Fed's been raising rates. So fourth quarter GDP at this point is looking to come in above 3%, which is quite strong given where we are in the cycle. And global economic growth is still sluggish, however, at slightly above 2%. On the next slide, just a look at where GDP growth is in the U.S., the Eurozone, the UK, Japan, and China, probably most importantly. The red line on this chart indicates China's growth, GDP growth over the last 10 years. You see they typically hover above the other economies, generating about 7 to 8% GDP growth consistently up until the pandemic. And they continue to struggle. You can see that their growth is only about 2.25%, and that's due to their COVID protocols and continued challenges in that economy. So not quite an engine for global growth at this point, but hopefully that will change in the coming year. Housing is one significant, on the next slide, Kate, housing is one significant factor negatively impacting U.S. economic growth. You can see that the existing single-family home sales are down over 20% since the Fed first hiked rates in March, and that's that red line on the lower left-hand side. That's a pretty significant decline in home sales. On the next slide, overall housing inflation rate is poised to decline. Here we look at the new lease inflation declining in the green, and you can see that even though rents as they're rolled in the current and next year will move lower, they'll still be higher, but the pace of increases is expected to come down nicely. And owner's equivalent rent looks like it's nearly peaking and is expected to move lower as well. The U.S. consumer has been incredibly resilient this year, and you can see evidence of that on the slide. There's extra savings associated with payments and lack of spending during COVID's peak, which equated to about $2.6 trillion, which is certainly supporting spending. Interesting though, the dry powder has been depleted in 2022. You can see that on the lower right-hand side, where there are many households, particularly in the lower half of our economy, that are starting to work through those balances and take on debt. On the next slide, you can see evidence of that. The consumer credit card debt has been steadily increasing since 2022. On the next slide, the Fed's response to higher inflation has been quite aggressive. We've had 6 rate hikes so far year to date, beginning with a 25 basis point rate hike in March, followed by a 50 basis point hike, and 4 75 basis point hikes. And you have to look back to 1981 to see a more aggressive hiking cycle. There's an additional 50 basis points of hikes expected for next Wednesday. for a total, rate increase this year of 425 to 450 basis points. And there's probably more to come on that in 2023. The ECB has also been aggressively hiking. They've had 2 consecutive 75 basis point rate hikes. They're also meeting next week and expected to raise rates another 50 basis points on Thursday. And the next slide, the Fed has aggressively hiked rates so far this year, and you can see that as evidence on the right-hand side. It's a very unusual hiking cycle. When you look at, say, the 2004 to 2006 period, where it looks like a ladder, we had 17 consecutive 25 basis point rate hikes. This time it's very different, and there's more of an immediacy given the high levels of inflation. As I said, it's not likely to end in 2022. There's another 25 to 50 basis points in rate hikes expected for the February 1st Fed meeting of 2023. And the terminal rate, or the end rate of Fed funds, where everyone talks about the pivot, is likely above the 4.6% that the Fed had previously forecasted. And more recently, Chair Powell has reflected that the time for rate hike moderation may come as early as December. And then again, that's why the markets are expecting just a 50 basis point rate hike instead of a 75 basis point rate hike next week. On the next slide, just another slide that gives you the depiction of how quick the Fed's moved rates higher relative to how it's done historically. The most recent hiking cycle in 2016 to 2018 started with 125 basis point hike, and then the Fed was on hold for a full year, versus again, almost 425 basis points of rate hikes in a 7 or 8 months this year. And then next, let's skip the slide. Kate, one more, please. The significance of the bond market developments this year cannot be understated. Obviously, 10-year yields have moved quite high from starting out in the year about 1.5% to almost 4.25% last month. They've come down pretty significantly over the last couple of weeks, and today are trading around 357. The yield curve inversion is also a signal that the market is anticipating our economy to go into recession sometime soon. And a recession is an inverted yield curve is when the lower rates are actually higher than the long-term rates. And typically, if you're investing out 10, 20, 30 years, you expect a maturity premium. That's not the case today. In fact, the yield curve is inverted about 80 basis points as of last night. The next slide, another look at the yield curve changes that we saw this year and last year. You can look on the left-hand side. The most recent indication is through the 29th of November, and that red bump up top on the upper left-hand side indicates there's continued expectations for higher short-term rates, but the rates have actually stabilized over the last 3 months on the longer end of the curve. The yield curve inversion is actually quite rare, and it is at its highest level since 1981, when it was about 250 basis points, which is very significant. On the next slide, high yield credit spreads are higher, but not necessarily compelling at these levels. You can see on the far right-hand side in red, the high yield spreads above comparable maturities have ranged this year between 300 basis points at the beginning of the year to as wide as 600 basis points over, and they're currently about 435 basis points. So a little bit of volatility, and I'm not necessarily sure in the face of a potential recession next year that those spreads are compelling. On the next slide, the U.S. dollar strength has been a persistent theme this year. It's been certainly a challenge for U.S.-based companies with sales and revenues that are generated from abroad, and as they repatriate those to the States in dollars to lower levels. It is, however, likely a lot more painful for our trading counterparties, as many commodities, in particular oil, is priced in U.S. dollars, so it's made it that much more expensive with the energy rate hikes and oil price increases in gas as well in 2022. The dollar has, however, weakened somewhat recently as other major central banks have taken up the mantle and raised rates fairly aggressively to combat local inflation. On the next slide, just a look at the recent weakness on the far right-hand side. You can see that the euro was buying at a low just 97 cents, trading below parity, and now it's about $1.05. Pounds were trading at a low of just $1.03 each pound bought $1.03, now it's trading over $1.20. And on the lower green-hand side, you can see that each dollar now buys about 138 yen versus a high of around 150. So it's come off the boil a little bit. The next slide, actually I love this slide, and I think the upper left-hand headline from the New York Times tells it all. And it's quote saying that since it's been the worst bond market since 1926, and maybe in centuries. There is some good news though, that most of the pain is behind us, which is somewhat optimistic. Also on the right-hand side, you can see that volatility is picked up in stocks and bonds, certainly in the third quarter, but again, it's come down a little bit in the fourth quarter. On the next slide, I'm sorry I keep getting back to the slide, but I actually think this is an amazing slide. I mean, really look at it and process the universal income increase in sovereign 10-year yields that we saw in 2022 so far. If you look at the top, you can see in line number 10, the United States 10-year Treasury started out the year at a 151 basis point or 1.5% rate, traded as high as 424, which means it's up about 220 basis points for the year. There are two outliers here, one being Japan. It's only moved up 18 basis points, and that's because rates and yields there are artificially being controlled to stay below 25 basis points through yield curve controls. There are days in the Japanese government bond market, or the JGB market, where there's no trading because of those yield curve controls. And the other outlier is on the very bottom, China. Because of the COVID protocols and a lack of really high inflation there, they've been easing. So they've actually seen their 10-year yields move less than a basis point lower so far this year. On the next slide, just a look at volatility. Volatility in stocks have actually come down a little bit recently. The 30-year average for VIX on the left-hand side is about 19. It's been trading as high as the low 30s in October and early November. Last night and today it's trading about 20, so it's pretty much where it typically trades. I think more interesting is on the right-hand side, the MOVE Index, which is a measure of Treasury volatility and price expectations, is actually quite elevated still. On the next slide, in terms of market returns, on the left-hand side, you can see equity returns, where we have the Russell 3000 in blue, still down about 18% for the year, and the developed international market, ex-US, down 23% year-to-date, and emerging market equities in red, down still over 30%. Just as interesting, though, on the right-hand side is a chart looking at the last 10 years. There's a very dramatic fall off in the Bloomberg U.S. aggregate. It's down about 16% year-to-date, which is a big move if you look at it, of course, in the context of history. On the next slide, really underscoring some of the problems and challenges that institutional investors have had. From the start of the year, the typical portfolio mix of 60 stocks and 40% bonds are down 16% year-to-date, so still challenging. And lastly, for some recent news, on the next slide, the upper left-hand side, you can see that there's been some real crypto challenges with the FTX default, which has actually spread into other areas of that market. And this morning there was news in the Wall Street Journal about a small hedge fund defaulting on $36 million obligation associated with FTX's collapse. So that continues to work its way through the economy. Below that, the fact that we've had three prime ministers in 3 months in the UK, so a little bit of geopolitical risk in Europe. On the far right-hand side, in the upper part, you can see Credit Suisse has had some challenges. Their credit default swap spreads have widened out considerably, and they're undergoing a restructuring. Below that, UK war continues with Russia and Ukraine. And finally, below that, there's been recent Chinese unrest or protests associated with COVID protocols, and we'll continue to see how that plays out. The expectations are for those protocols to be lessened and mitigated, and hopefully have a positive impact on growth there, a reduction in bottlenecks, which hopefully will pull down inflation around the world as well.
Steve, for just food for anyone who is watching this, that one retiree who may be watching or reviewing this, We do not invest in cyber currency.
Yes, we don't.
We won't have any exposure to it. This is essentially a private market. It's not backed by any governmental entity. So if the whole thing collapses tomorrow, which it could happen, other than those who have squandered a lot of money investing in it, which essentially in term of art, they're shit out of luck, then you know, but they can't, it's not gonna affect us unless it has an overall effect that some major players have invested, and they're gonna have to cover their losses somehow.
Yeah.
But we do
That's
not
right.
do that.
That's exactly right, Joe. All those points are correct, completely accurate. I put that on there only to indicate that there's still some cracks in the marketplace associated with rate hikes and, perhaps a risk for, a threat for return in the crypto space. So you do look for contagion throughout. That's why I mentioned FTX in the context of geopolitical risk and what is potentially going on with a large bank. Although, you're absolutely right, we don't have direct exposure.
Just wanna make sure that people
Yep.
know that we're not,
All good points.
we may be crazy, but we're not that crazy.
Okay, on the next slide, and this is just food for thought, and I need to emphasize, the next few slides have zero predictive value, but I think it's interesting to take a look at where the VIX had traded and the pattern of the VIX in 2006 to 2009 relative to where it's been more recently since August of 2020. And you can see that this followed a pretty close pattern more recently in terms of the market action and expectations around volatility for equity prices. And perhaps even more interesting on the next slide, and again, zero predictive value, is a charting of the S&P 500 from that same period of 2006 to August 2009. Again, right before Lehman's default in September 2009, relative to where the S&P is traded from August 2020 to today. And you can see it's a pretty close pattern. Again, not predictive, but something to be thinking about. We've obviously experienced a significant rate shock in the U.S. with inflation high, and the Fed's aggressively hiking rates. At some point, that will spill over into challenges for the real economy and perhaps earnings declines. And what we look for and hope we don't find is a liquidity crisis or liquidity shock at some point that drives everything lower. So just food for thought and things to be thinking about as we go into what I believe will be another challenging year, certainly in the first 2 quarters. A couple of slides forward, take a look at the performance for the 3rd quarter. Thanks, Kate. Obviously, you can see on that middle Q3 22, it's certainly been a tough quarter. And I think for the full year to date, it's actually been a tougher year. A lot of red on those screens. It's been a challenging time in the marketplace for both equities and fixed income. As I suggested earlier, fixed income's had a little bit of a rebound and that the yields have moved higher, which perhaps makes those better investments for longer term portfolios and to provide a little bit more ballast. Buying 10 years or owning 10-year treasuries at 1.5% is typically considered expensive, and the market has probably gone to an extreme. On the next slide, a look at the fleece net public market returns by strategy. You can see that, again, it's been a tough quarter and a tough year. The only exception would be cash that's consistently provided a positive return. But I would need to remind everyone we typically have a zero asset allocation to cash, and it's really there to meet capital calls and distributions to beneficiaries. But again, a challenging time, and your performance has certainly been consistent and in line with the public asset class benchmarks generally. On the next slide, perhaps a little better news is the performance of private assets.
Sorry,
Next slide, Kate.
text her that there's been a bit of there's like a delay on her end, and she's trying to.
Okay. No, you're doing great, Kate. You're right with me, so thanks. But taking a look at private markets, you can see that the performance has been not bad over the course of the last year. Hedge funds have provided a nice diversifier and a source of income generally, although they're marginally down for the year. But private equities, notwithstanding the challenges in the public markets, still up 11% over the past year. Core real estate up 30%, non-core real estate up 22%, infrastructure, 14%, and opportunistic fixed income, again, marked through, September 30th, about flat for the year. More importantly, on the lower part of the screen, you can see actually the police total plan returns for the, sorry, thanks, Kate. 3.7% in 3 months, which is outperforming your policy benchmark, considerably at 5.1% negative. Not a great result because it's negative, but on a relative basis, providing some benefit. On the next slide, just a look at that outperformance. The net outperformance has been about 132 basis points relative to policy benchmarks, and that's driven by under and overweights in terms of asset allocation by negative 10 basis points. But on the positive side, 142 basis points of positive performance coming in primarily through investment manager selection. On the next slide, I'll look at the police market's excess returns and basis points across the strategies. And here you can see in 3 months, some consistent challenges still in the Russell 3000. Equities, though, have come back quite a bit in the developed markets international, ex-US, plus 13 basis points for the quarter, and emerging market equities up 116 basis points. And obviously, you can see in the full year, we've had some real challenges in both areas, but it's nice to see that there's been some clawback of those negative returns earlier in the year. And lastly, on the next slide, a look at the private market outperformance for police. You can see in 1 year, in private equity, it's produced a 1-year excess return of 2,680 basis points. And that's due to a couple factors. First is the strong performance of private equity, and also the fact that the benchmark is the Russell 3000 plus, and the liquidity spread is 300 basis points. And the Russell 3000 for the year is off still about 18%. The only red on that screen of note is the 1-year returns for the non-core real estate. And that's driven more by the fact that you've had a number of investments that have been made since 2018. So for the last 4 years, they basically are in that part of the J curve where they're requiring more capital calls and providing no distributions. And that will certainly reverse itself at some point down the road. You've also got some investments that were prior to the GFC that are a little bit of a drag on performance, and perhaps COVID hurting certain assets. But as a general matter, solid performance, particularly in private markets. Again, and those marks are through June 30th, with the exception of opportunistic fixed income, and then the other slide, page on. On the next slide, and we have the benefit of both John Mercerberg and Robert Fang in the room, but just look at the rebalancing activities for the quarter. There was a move that John put forward to move out of the Russell 1000 to the Russell Top 200, as well as we sold some Wellington mid-cap exposure. And I think the balance in fixed income, you can see the cash desk raised $370 million. And again, that was to meet capital calls and beneficiary distributions for the quarter. And lastly, before I turn it over to our Chief Risk Officer, Ed Berman, the under and overweights by asset class. And you can see on the far right-hand side, as of the end of September, everything was pretty much in line with where it typically would be, and certainly within our target range. So any questions, anything that I didn't cover that you want to know?
I had a question. When you showed the high yield index and this year 600, I had a question related to our OFI, some of our OFI managers that have trigger-based capital. I don't know if Tina's here. She might have an idea. I was wondering if we are in a window where some of those, where in what was defined as an opportunity set, I guess, to invest or not based on some of the triggers.
Yeah,
if that's been used.
Yeah,
Some of those are, I would say, in second quarter 2020 initially, and I know some of the CLO managers were probably not funded also have.
So let me just caution before anybody answers If it's manager specific, we will be going into executive session. If it's, I'm just cautioning everybody that's on. If it's manager specific conversations, we should really hold those in executive. But if there are general questions about the portfolio, then now would be the right
Yeah, I mean,
time. I'm just putting that on the record.
Yeah, I mean, are we in a window now when, what were just to understand when was those opportunities?
Yeah. So typically those windows are called accordion provisions are excellent because they enable your external managers to call capital when things cheapen up. So typically you'll look at either the dollar price and high yield. If it gets below 80 or close to 70, it can be a trigger. It also looks at credit quality spreads. So in high yield, typically it's about 600 basis points where they can call additional capital.
Right.
But typically, Shuman, that's a great question. There has to be at least a week or 2 week window where it's above those elevated levels where prices are low or yields are high, so that capital will be called and then be put to work. Those are excellent provisions because they now enable the portfolio to be a contrarian investor when things cheapen up. Tina, if you're on the line, do you have anything you want to add to that? She's in today.
Yeah.
Yeah.
So the trigger capital are have been deployed. And recently also triggers conditions were met again. So those are deployed consistent to the way triggers are set. We're confident that there's a large opportunity set. It's just, we need to have adequate capacity.
So we're currently no, we're not.
No. It's credit, high yield credit spreads right. I saw this morning on Bloomberg, they're 433 basis points. The triggers are typically 600 above. So if you think that at some point there's going to be a decline in earnings, potentially a recession in the U.S., that it's likely the credit spreads will widen. So I said I don't think they're currently compelling rates, but above 600 basis points, I think they're probably more compelling. And then those triggers, if they come into play, would enable us to automatically put money to work for the portfolio, based on what's already been approved.
That's right. So there's the spread trigger and the price trigger. Price triggers were triggered. Spread triggers haven't been hit yet. So that's the way we kind of designed it to give managers some flexibilities as well.
Great, thank you.
Any other questions?
Okay, so Ed, we're going to turn it over to Ed Zimmerman to walk us through a risk presentation. And again, at any point during this conversation, if there are questions, please feel free to interrupt us and ask. We don't want to say something that goes over somebody's head or goes by the wayside if there's a question. So with that, Ed?
I completely agree with what Joe just said. So please stop me at any moment. And so we'll talk about these mostly following the same framework we introduced last time. So we'll be 3 sections of our discussion. Page 1 will focus on the total plan. We'll look at the entire system and the changes in risks. We'll put in the context of the market environment. Page 2 will dive inside the portfolio. We'll look at the individual asset classes, the risk levels, and the performance. And page 3 will be our forward-looking projections. And that's where we'll present you some new analysis that came out of, as we develop our framework, this additional views, which we'll discuss later. So let's dive right into it. So the total risk level for your portfolio at the end of Q3 was 12.7%. It's the number you see at the bottom right corner of the table. And much like last time, we'll try to put this number in the context of the markets and portfolio construction, right? So as we build a portfolio, there's a series of decisions we take, starting with the most important, determine the stock-bond split, how much equity to put in the portfolio. Obviously, equities bring more upside, but more risk. So it's captured in column 1, market portfolio. It's a simple blend. It's a 65% MSCI ACWI and 35% of Barclay US Ag, which are both very broad measures of equity and fixed income markets. The next step in the portfolio construction process is the asset allocation, and that is captured by the policy benchmark. And the asset allocation where we split the equity and the fixed income portion of the portfolio into individual asset classes. And altogether, we have 13 components as shown at the bottom of the page. And finally, the last step is actually the portfolio where we select managers and any technicals, the cash demands, the rebalancing activities. And that's reflected, of course, in the columns in the table. So starting with the market portfolio, which is our measure of the market input on the system. It's the simple 65-35 blend. In the column 1, let's start with the portfolio construction. So there are 3 main dimensions of risk, or 3 main dimensions of money-making opportunities, right? It's the equity exposure. It's, of course, the interest rate exposure or the cost of capital, and the credit exposure for the risk of default, meaning that money lent is not repaid back by the borrower. So the equity allocation obviously is 65% by construction. That's how we chose it. The interest rate exposure is measured by so-called duration, and you see the duration is 2.2 years. And what does it mean? I usually think of duration as just the simple multiply to translate the rate moves into the market value moves. The duration of 2.2 years means that if interest rates were to rise by 1%, the market value of the portfolio declines by 2.2%. You'll notice that the duration declined slightly for this quarter, and it's simply the impact of the interest rates. As interest rates increase, the duration tends to trend lower. On the credit spread side, again, we use the duration as a measure of exposure. You see duration is 1.3 years. Again, it's a simple multiply to translate the move in the spreads into the market value. You'll notice that the spread duration is slightly lower than rates duration. It's simply a reflection of the fact that Barclays Act is mostly government bonds. It's mostly treasuries and agencies, and it's about only 40% of Barclays Act has credit exposure. So what does it mean for risk? You see at the bottom of the page. So the total risk for the portfolio, for the market portfolio at the end of the quarter was 12.5%. And just to remind, what this number measures is the expected return, expected performance of the portfolio. So when we say the total risk is 12.5%, we mean that the expected performance of the portfolio over the next 12 months will be within a 12.5% range. And this is about 15% chance the performance will be better. Unfortunately, about a 15% chance that performance will be much worse. You'll notice that the total risk ticked up slightly by about 0.5%. And that's purely the result of the market action. As Steve highlighted in his presentation, obviously markets have been very volatile. So equities, as measured by the VIX index, VIX index closed about 30 at the end of the quarter, and that's compared to about pre-COVID average of 18. So it's a factor of 50% higher. And then fixed income, the action was even more dramatic. The MOVE index closed at 160 versus the pre-COVID average of 60. So it's almost a factor of 3. So it's not surprising that your portfolio, the market portfolio increased in the risk level. And we also present the second measure of risk at the bottom of the page, which is the beta to the S&P 500. And this is more of a short-term measure of risk. That's basically the response of the portfolio to the changes in the S&P. And the S&P, of course, is by far the most important index in the global markets for equities. And the beta of 0.61 means that for a 1% increase in the S&P, the portfolio will rise by 61 basis points. Notice this number is actually lower than the equity allocation, 65%, and it's simply the impact of diversification. That's how we expect it to be. It's exactly why we do a multi-asset portfolio. And you'll notice that the beta was fairly steady for this quarter. So with this in mind, this market portfolio gives us a useful point of reference as we transition to the strategic benchmark and then to the system itself. So moving on to the policy benchmark that's captured in column 2. You'll notice broadly it's aligned with the market portfolio, but there are some important changes. First of all, the equity allocation moved slightly higher. So now it's 67% versus 65. The 2 extra points is actually quite significant. You'll notice that the interest rate duration is slightly lower. It's 1.5 years versus 2.2, and that's simply because your benchmark is a material allocation of high yield. It tends to be of a shorter maturity and therefore shorter duration. And also the spread duration is lower. And that's again because of the TIPS allocation, more government exposure in the policy benchmark. So what does it mean for risk levels? You'll notice that the total risk level is actually lower than for the market portfolio, 12.2%. And this number is lower despite the slightly higher allocation to equities, right? So that's a positive outcome. It tells us that the asset allocation is working. I think it's an important conclusion in the current, especially in the current environment. So the asset allocation still gives us that diversification, gives the ability to take more exposure to equities, and I see it as a positive. And lastly, the beta to S&P, the last point in the table, 0.61, the same as market portfolio. Again, it's a good thing. So let's move on to the portfolio itself, right? So the last column, 3. You'll notice there are small differences. Again, starting with the portfolio construction, there are small differences with the policy benchmark. The yield of material. The equity allocation, 67.7 versus 67, is within daily fluctuation range. The interest rate duration, you notice, is slightly longer, and that is because we make allocation to the ECI program, which brings high duration mortgages, and the spread duration is in line with the benchmark. So what does it mean for the risk levels? You see at the bottom of the page, as I mentioned earlier, the total risk for the system, for the entire portfolio, stands at 12.7%. That's about a 0.5% higher than the benchmark. And the reason it's high is primarily because of private equity. We'll see more about it. We'll talk about the next section. But the majority of the difference is driven by private equity and primarily the U.S. leveraged buyout strategies. The beta of S&P is also slightly higher. It's consistent with slightly higher risk level. And we'll also introduce a third measure of risk here, which is arguably one of the most important measures, that is active risk. So active risk is very similar to the total risk number. It's a measure of the expected excess performance of the portfolio. So it's excess returns over the benchmark. So the active risk of 2.3% means that the expected excess return over the next 12 months will be within plus minus 2.3% range. With, of course, the usual disclaimer, 50% probability to do better and 50% probability to do worse. And lastly, I want to draw your attention to the chart on the right-hand side of the page. First of all, chart number 1 that shows the last 12 months how these 3 portfolios performed. And you'll notice that the relationship we talked about broadly held steady over the past 12 months. So the portfolio is driven mostly by the markets, as you would expect from a steady, matured portfolio. No big surprises. I suppose it's a good thing. Nobody wants surprises in the area of risk management. And lastly, the second chart at the bottom of the page, active risk, again, no big surprises. You'll notice it's standing slightly higher, and that's completely something we expect in an environment of complex markets and high market volatility. So if there's no questions, we'll move to the next section. We'll dive into the portfolio. Can we have next slide, please? Thank you. So again, same slide we saw last quarter. So here we look at the asset allocation and the risk consideration and performance across the portfolio. So we split the portfolio into 3 broad sections: public equity, public fixed income, and alternatives. Let's start with allocations, column 1. You'll notice there are small differences on the public markets. It's really within daily range, nothing to talk about. This is well within our guidelines, and it's not something we'll worry about. On the alternative side, again, much like we talked before, there are some notable differences. specifically on private equity is running slightly above the allocation, 2.4%, where infrastructure and OFI is running slightly behind. Again, I hope I'm not creating any news here. The next step, we'll look at the risk level, risk contribution in the portfolio. It's captured in column 2. I will mostly refer to the chart at the bottom of the page, which shows the same information, graphical form. And that's where you see the blue bars that represent the allocation or market value exposure, and the orange bars represent the risk contribution. So a few things stand out, and again, this issue is mostly similar to what we discussed last quarter. You see 2 asset classes that punch well above their weight. That is U.S. Public equities and private equity. Again, it's most primarily U.S. allocation. You'll notice that the fixed income strategies provide useful balance and diversification of portfolio. In particular, core fixed income has a material market value allocation, but contributes almost no risk. The same goes for the TIPS allocation. High yield, where there's more allocation. But again, there are no big surprises here, so I will not dwell on this chart unless any questions. Probably what's more interesting is the active risk. So this is column number 3, and that's where we assess the risk of individual managers and individual asset classes versus their respective benchmarks. Again, we're in a fairly interesting market environment. That said, you'll notice that at the top level, public equity and public fixed income run at a very small active risk, 0.8. That's exactly how we want it. It's by construction, and alternatives, since they assess versus public benchmarks, run at a very high level of active risk. No surprises. Let's look under the hood. Starting with public equities, one line that always stands out for me is developed markets ex-US. So that's where you see active risk 2.7%. That's quite a big number. Again, not unexpected. That comes mostly from active exposure we run in the strategy. Some of the managers, based on John's recommendation, I will not name them, but some managers running active risk of 18, 15%. So very high active share. Again, that's what we expect from them. But you'll see that this high level of risk seeps into the performance, right? So if you look on the right-hand side, when we look at the returns over 12 months, specifically developed market ex-US, you see pretty punchy numbers, right? So we exceeded our risk projections for the absolute performance. Again, I'm focusing on the developed market ex-US. And also, which I find more significant, we exceeded the active risk, which is excess return, quite significantly. On the fixed income side, public fixed income side, again, the performance is negative. I hope nobody's surprised by that. Steve framed quite nicely. But on the excess return basis, active risk, the managers delivered mostly within expectations. Convertibles being one exception. Again, it's a little peculiar asset class, very technical. But broadly speaking, I do not see any surprises other than performance is consistent. Unfortunately, consistent with the market, but again, it's consistent with the mandate. On the alternative side, you see big numbers, right? So performance obviously has been outstanding, but also the risk levels are fairly high. In particular, for private equity, you see active risk of 18%. It's a big number, but private equity is assessed against the Russell 3000, which arguably not the most durable, but probably still the best proxy. And that's just a reflection of idiosyncratic nature of this asset class. That's why the system is invested in it. And also intuitively, we know that private markets do not perform the same stuff. We see it all the time. So this number kind of makes sense in the context. Performance obviously has been strong. I just want to call out private real estate, where the absolute returns exceeded our risk forecast more than by a factor of 2. So that's exceptional. I hope it will last. Again, risk doesn't make any predictions for the future. but it's obviously an outlier. And at the top level for the entire system, the active fee stands at 2.3%. About 3/4 of that comes from private equity, and probably 75% of that comes from leveraged buyout strategies, both small and large. Are there any questions about these performance? I'll just pause here for a second and we'll move to the forward projections. Okay, can we have next page, please? Okay, can we scroll down? Oh, thank you.
Yeah, there's just a slight delay.
Good, thank you. So that's where we present our forward-looking projections. Again, you'll notice this page looks a little different. So I'll walk you through this analysis, and that comes up from a recent developments as we enhance our risk framework at that. So we obviously do not know the future. We cannot predict what the future will bring. So it's a little difficult to find the expected moves for the market. What we can do is identify which factors may hurt us the most. Which part of the world we need to watch out for. And with this in mind, first of all, we split the world into 3 broad buckets, from the macro perspective. That's equities, rates, and commodities. So starting with the equities, and you see it line 1 through 3 in the table. The 3 main global centers in the markets are obviously the United States, Europe, and emerging markets in China. So between these 3 centers, we'll cover about 75% of the global equity markets. For the United States, cover about 41%. Markets have large allocation than the GDP. So these centers, these factors are captured by the S&P 500. It's the main index for the United States. The MSCI, which is a proxy for China, broadly speaking, in emerging markets. And lastly, the Euro Stoxx 50, which is a broad measure of the European stock. Moving on to the rates bucket, we identify a few rates. First of all, the 2-year Treasury. And probably the most important action in the rates world is obviously the Federal Reserve. It's in the news all the time. We talk about it all the time. And probably the best proxy for the Federal Reserve policy rate is actually the 2-year Treasury. So it captures what the Federal Reserve is doing, but also captures the expectation of the marketplace for the next several moves by the Federal Reserve. The 10-year Treasury is more connected to the real economy. That's obviously it's one of the key points for pricing of mortgages. It's an important part for investment grade borrowing. It's one of the key rates in the global economy. And lastly, the US dollar. So it's the most important currency globally. Obviously, the dollar has been in the news with the historical run-up and somewhat softness recently. We capture the dollar cent by the euro-dollar exchange rate, which has about 60% weight in the dollar index. And lastly, commodities. Commodities represent the real economy, where people make stuff and transport stuff. And here we identify 3 main indices. First of all, line 7 is copper. And copper actually goes into pretty much everything is being produced. Copper prices correlate very highly with the GDP. It's one of the best proxies for the global economy in general. Then oil, and oil obviously goes into anything, from manufacturing to transportation to heating. And lastly, inflation. There's no need to introduce inflation. We live with this in the headlines every day. So with these 9 factors, our next step is to identify the worst move. And of course, we have no forecasting ability. We cannot predict how this market will perform in the future. What we do, we look at the worst move in the context of the current markets. And in this case, we're trying to forecast the 8% move for the market. Why do we pick 8%? 8% is about 1 month a year. So you can think about the trade as the worst monthly performance over the next year. What's important to underscore, all of these moves are equally likely. They carry the same probability. It gives an ability to assess the impact on the portfolio. So I'll pause for a second to just look at these numbers, and they captured on the market move in the table. These are big numbers, right? So you see that we forecast the equity moves up to 30%. Again, it can be either up, melt up, or melt down. These are big numbers, right? And intuitively, again, they are not completely out of context of the past years in the markets. On the rate side, you see that the 2-year treasury may gap by 160 basis points. Again, it's a huge move. Hope it will not come to this. But given the recent, and again, going back to his presentation, his chart about the fast run-up in the Federal Reserve policy rate, not unthinkable. The euro-dollar exchange rate, 10%. Again, it's a huge number, not impossible. And lastly, on the commodities, copper price is 35% move, oil 57%. So to give you the context, so oil is about what, $77, $78 currently. 57% move takes oil anywhere between $33 and $120. Huge uncertainty, big move. And lastly, inflation, 2.9%. Again, putting in the context, again, the Federal Reserve targets 2%, it's a big number. So what does it mean for your portfolio? So here we present the risk on and risk off scenarios, the color coded red and green. Risk on is defined as assets rallying, which is part of the portfolio, and risk off, of course, is a sell-off. So altogether, we present 18 scenarios here, both for the benchmark and for the system overall. So I'm not going to read these numbers. The most important stats that are highlighted. Starting with equities, the S&P 500 is by far the most important index. So for a 27% move in the S&P, the portfolio will gain 17%. But what's important here is that the exposure to MSCI, which is here approximately for China, is much lower. The exposure to Europe is lower. And you may say we know that because we do not allocate much to China, we don't allocate much to Europe, but allocation is not the same as exposure. Like you can see it in the recent news when Apple stock took a dive because of problems in China because of the COVID lockdown. There may be strong spillover effects. So looking at these numbers, I find a lot of comfort in knowing that we're more exposed to domestic equities, where I'd much rather we be there. We have much less exposure to China and Europe, where there are a number of macroeconomic challenges. So it's a good outcome. Great. That's probably I found the most interesting among all three. So first of all, take a look at line 4, the 2-year treasury, which is a proxy for the Federal Reserve moves. So for a 160 basis point move in the Fed for the Federal Reserve, the portfolio gains only 50 basis points. It's a small move. What it tells you is that the portfolio is not sensitive to the Federal Reserve policy rate, but to other factors, some other factors. The same is true for the 10-year treasury, even though the impact is slightly larger, but it's not huge. But look at the dollar, line number 6. That's where the number is getting big, 6.2%. That's quite significant. So when you think about rates, what we need to worry about is not the Federal Reserve, not the yield curve, it's the dollar. And what's positive here is the weakness in the US dollar. If the dollar is selling off, the portfolio gains. And lastly, let's move on to commodities, which also I find quite interesting. So the exposure to oil is surprisingly not something you need to worry about as much compared to copper. And again, copper is a proxy for the global GDP. Probably not that surprising given that it's a broadly diversified portfolio with exposure to every corner of the world. And of course, inflation. It's not surprising, it's been in the news. So inflation is one of the biggest factors for the performance of the portfolio. And that's when increase in inflation will be positive for the portfolio. So a drop in inflation will result in loss. So in conclusion, I just want to bring it all together and summarize. So 3 main points to take away from this. First of all, The main macro factors that impact the portfolio and something we need to worry about is, first of all, the U.S. domestic equities, S&P 500. The strength of the dollar, where the weakness is actually beneficial to us, and the inflation rate, where an increase in inflation will be beneficial to the portfolio. The second point is, I would say, relative lack of diversification in the portfolio. And that's why I will refer to the chart at the bottom of the page, where we show the impact of these three scenarios on individual asset classes. The most important thing to note is that it's all moves in the same way. Right? So it's almost all asset classes move either up or move down under the same scenarios. So the only outlier is core fixed income, which sounds coincidental under all these three scenarios really produce no meaningful impact on the portfolio, but beyond that, it's all either positive or negative. So I would highlight relative lack of diversification. And the third point I'd like to make is if you look at the policy benchmark versus the portfolio itself, under the risk-on scenario, in every single scenario, the portfolio performs better than the benchmark. But if you focus on the risk-off environment, in every single scenario, the portfolio performs worse than the benchmark. This is consistent with what we talked about on page 1. So the portfolio is at a slightly higher risk level than the benchmark. That's not unexpected, but there's a lack of what we call convexity, meaning that what we wish we saw, the portfolio outperforms in the upper market, we capture the upside, but also proportioning to the downside. And we didn't see it under this business. So I'll stop there. And any questions?
Any questions?
That was a very thorough and succinct presentation.
Thank you.
Okay, so with that, there's no further business for public. I'd like to make a motion to exit the public session, enter the executive session.
Do we have a
Second.
Second, Joe? Okay.
Okay, a chorus of ayes.
All in favor?
Aye.
None opposed? All right, so moved.
Okay, so if you could stop the recording.
Recap. Right, trustees heard presentations from Bureau of Asset Management CIO and staff, as well as presentations from fund managers and consultants. Decisions on these presentations will be disclosed at the appropriate time.
Thank you, Bob, and I will make a motion to adjourn.
Motion to adjourn.
Motion second.
Second.
Vic Swinton?
Vic Swinton, get
Vic Swinton on the record.
Vic, big guy.
All in
Okay.
favor?
Aye.
All right, you're out.
He said, we're out of here.
Thanks, Yaffa.
ABC, see you later.